Friends, in this video for I Thought Wealth, I am going to talk to you on the topic large caps versus mid caps. Valuation has to be a driver of our decision making. Where we channel our money should be driven by valuations. Most people think that valuation is secondary to growth, but when secular growth returns, markets will always gravitate towards stocks which are more attractively valued. The last few years have seen very uneven growth. In fact, we never had growth at the macro level or at the headline economy level. So, growth was only at some sectoral level. When you don't have overall economic growth, investors chasing growth tend to go wherever there is growth and pay whatever they need to pay just to participate. So, that context cannot be extrapolated into the future, and it cannot be made into some kind of a rule which you follow. So, as secular economic growth comes back, all sectors start growing, then investors will start scrutinizing value more closely. In fact, wherever investors have overpaid for growth and are sitting in overvalued stocks, they tend to sell some of those stocks and then go into stocks which offer better value. And even within sectors, this is likely to happen. So, somebody who is holding an NBFC which is supremely expensive can well sell that NBFC and go into some other stock which is more attractively valued and which is even larger, because investors will want stability in their long-term journey. The last few years have made us gravitate more towards mid caps and ignore large caps. The reason is that we were definitely wanting growth and we did not want to buy value. So, as we gravitated more and more towards growth, we concentrated our investments more into mid caps, and that space offered better growth than the large cap space. So, this trend is something which has created disproportionate returns in mid caps, and it has also taken our attention away from large caps. But the correction that we have seen in 2022 has created a strong reason for a rethink, because larger companies are becoming more attractively valued. These are companies which could be compounders, and we are seeing the mid-cap companies coming off one after another and not living up to the expectations which we had built into them. As the economy grows in the coming year into a stronger place, into a larger size, it is quite likely that the bigger companies will come out better and will perform better than companies where our expectations are already running high. It is a fact that our expectations out of larger companies are lower than they were historically. We are now thinking that larger companies will not deliver too much. At a market-wide level, people are not willing to look at larger companies and they want to go into smaller and smaller companies. But if you look at safety, if you look at where there is value, and if you look at where growth will come, larger companies probably offer a safer domain for us to channel our resources and to invest comfortably for significant compounding returns. So, we need to rethink that and be very, very precise in what we are buying. We should be very, very correct in how much we pay. We cannot afford to overpay and still succeed. This is something which worked for a few years, but it's not going to work forever. So, be correct with how you invest your money. Deploy your money where you see value. Be very accurate in your measurement and set your expectations correctly. In my opinion, large caps offer far superior investment opportunities now than mid caps. And I'm sure this is dynamic, but for now, it is large cap where your focus should be. Thank you for watching this video.